All right. So this is Shari Frasure, and I am a real estate agent with Keller Williams Greater Lexington. And today I have with me Wells Fargo Tenia Debord. She's a loan officer there and has been for several years. We're located in Lexington, Kentucky, and we had decided to do a series of some webinars and just to give some information and education on the mortgage process and how you go about getting a loan and qualifying and then being able to purchase a home. And I've got a few things that I wanted to talk to Tina about and let her explain to you. But one of the things that I wanted to discuss today was the first-time home buyer loans. A lot of times I'm asked if there are special programs for a buyer if they're a first-time home buyer. And there's some misconceptions around that term. Just because you've owned a home before does not mean that you don't qualify as a first-time home buyer in certain situations. And Tina and I have been discussing some of the products that she offers through Wells Fargo that may not be available through other lenders. So how are you doing today, Tina?
I'm great, Shari. How are you?
Doing really well. I'm sorry we can't do a video right now. Next time you'll get to see Tina's pretty face, but right now we're just going to have her voice, and we've got some things to share with you. I have pulled up here, and we're going to just kind of talk about a few things, and then we'll refer to the PDFs that we've got here on the screen. But so Tina, why don't you just tell us a little bit about you and Wells Fargo and just give us some background.
Well, sure. I started out at Wells Fargo, the fall, October of 1998. Started out as a temp, worked my way up to a CSR. Then I was an assistant for a number of years for a top producing salesperson at the time. And for the last 16, 17 years, I have been a home mortgage consultant. So I originate a wide variety of loans, pretty much any kind of mortgage that can be had on a piece of property, I do. The only thing we don't do is we don't do Kentucky housing, just because we don't have a lot of need for Kentucky housing for us. Mm-hmm. There's need out there, but I don't get a call that I haven't done. Even when we had the product available, I haven't done one in years and years. Mm-hmm. But anyways, we have a wide, we do things a little bit differently. We offer a different kind of product and some different things that other lenders don't. Some products that are exclusively Wells Fargo. So those are the things that, I think that every lender has to really focus on, is the things that set them apart. Anybody can do a vanilla 20% down conventional loan. Anybody can do that, but not everybody is vanilla, right? Mm-hmm. So that's a little bit about me. I do enjoy my job. I could talk all day long about it. So.
Yeah, we've had some pretty lengthy conversations about various different things around mortgages, and of course you and I have worked together in the past. Been in real estate since 2002. And so we've had a lot of interaction, but I'm really excited today about the things that we're going to talk about, because I think that there's a lot of questions that buyers have around the mortgage process in general, and a lot of confusion about what they could or could not qualify for. And sometimes I think that keeps them from even trying, because it's such a daunting thing. It's pretty scary your first time in purchasing a home and going through that mortgage process. And then a lot of times they also think that their credit's so poor and that they don't have any hope. We both know that even though you have, not the highest credit score right now, sometimes it's easy to get that fixed where you can qualify. And then there's things like, the down payment. It's not just a 20% down anymore. That hasn't been really the case, and I can't even remember when. I know that it used to be that way back when, and interest rates were a lot higher than they are now. I mean, we've got historically low interest rates right now, and so it's just a matter of just talking to a loan officer and finding out what you can qualify for. And a lot of times, people loan officers like you can kind of give you some guidance on what you need to do to get your credit score up to where it's to your advantage or where you can qualify.
Yeah, and that's the other thing that Wells does is Wells does have a program where they have a special team, or we have volunteers that work in banking locations that agree to do counseling with clients that are not to that point of being ready to buy, but they need somebody to help them, to guide them, a guide, so to speak. So we have volunteers within our banking that do that.
Right.
And they actually get volunteer hours through Wells, and that's highly encouraged for to give back to the community. So with that being said, that's something that I can't. If they're not there yet, they will be. We can get them there. If the client is committed to buying and doing what it needs to get to that point, then yeah, there's opportunities for them to have some assistance through our banking partners that are they may be in Virginia, they may be in West Virginia, they may be in California, but they will touch base with them and walk them through and guide them through the process of credit improvement, the things that they need to address, versus paying somebody to
right. That's what I was going to ask you, and that's free of charge.
Yeah, it is. There's no cost at all, at all. And it's free, and they offer just so much, so many tools out there for them, for a person that is not to that point of being ready to buy. If it's beyond something that I can help them with in a very short period of time, and it's going to require some months, then that's what we'll do is we'll refer them to our bankers that do that.
Yeah. And isn't it true that just, maybe you wouldn't be able to help them, but you could refer them to someone that might be able to, run them through, like, say, FHA, or if it was something that would be more likely that they could get approved. And I like that about you, is that you don't, try to just hang on to the buyers and not try to help them if you can't. So.
No, and every lender has got a set of overlays that are put in place by their lender, right?
Right.
And for us, a 640 credit score is a requirement for an FHA. I know that there's other places, and you probably know those places too, that will do below that. We just don't.
Right.
So, and I know there's with this COVID, I know there's been some other retractions for other lenders as well, that they have pulled back from offering, below that 640. But that to me is if I can help you and somebody can get it somewhere else, then get a loan, then I think that's only right. That's the right thing to do.
Yes. Yeah, I agree with that. Of course, there's several things, like I said, that I've written down here that I kind of wanted to talk to you about. But let's just say that I am a new buyer. I'm a first-time home buyer, and I come to Tenia Debord at Wells Fargo, and I'm trying to see if I can qualify for a loan. What would be the first thing that you would tell me?
I'm going to, first of all, I'm going to get to know you, find out if you're renting, get some ideas about where you're at as far as, do you have a down payment? Do you have an idea what your credit is? Before we even get to the point of doing an application, just kind of going deep with the client, finding out, what they're looking to do, what their long-term goal is. It's more than just taking an application. That's my opinion. So when I start talking with somebody, I'm not just as I'm talking and it's being just kind of get to know you kind of thing, I'm picking up on things that are important to them, so it helps me figure out, what product we have that will help them meet their ultimate goal. And so, from that point on, then we can progress to just doing a prequalification, which doesn't involve credit, or we can go to a PreApproval, which would involve us pulling credit. So, I let the client kind of guide me as far as how fast they want to move. you know.
Okay.
And if they tell me I've talked with Shari and we found this house, and I know from talking to them, from that we need to move quick, especially in today's market. We don't need to be fooling around with pre-qual. We need to go straight to pre-approval.
Exactly. Yeah. Now,
and getting
touch on that real quick. What is the difference between pre-qual and pre-approval?
Okay. Prequalification means that you're taking the information that the client's giving you without pulling credit. You know, they're going to tell you what they think their credit is, good, bad, fair, whatever, you know, 600, whatever, you know, and then their income and what they owe monthly, obligations, car payments, credit cards, student loans, all of those things that they pay. And then you're going to see, you know, use that in relation to figuring debt to income ratio. Now, I know we're talking a lot of jargon here, but depending on the product, as to what they can owe and other obligations, plus a house payment, is going to come up with what is called the total debt to income ratio. So, you know, and again, it varies from product to product, and it will even vary from client to client,
right?
Depending on credit score. So
so that is basically relying on them to give you accurate information, and you're just going by what they've told you, and you're not verifying anything.
Yes. And that's where I think a lot of folks get hung up, is they don't know the difference between pre-qualification and pre-approval. Pre-approval means the credit has been pulled by the lender. They have reviewed it, coupled with the information you have provided, and they have made a decision that, you know, whether it be through an automated system of decisioning or a body has looked at it, have determined that we can do a loan for you. Okay. So
that's still like not a guarantee that they're going to get the loan, because you haven't actually looked at the information or taken their documents and send it through underwriting. Okay.
Exactly. Now, the only time, you know, for instance, with rural housing, because rural housing does have a 2 underwriting process, the lender plus the guarantee through rural housing. If you're going to get a pre-qualification or pre-approval, for somebody doing a rural housing loan, it's really got to be physically looked at by a body. I know for us it does. Somebody else might be able to do it, but for us, our system, our automated decisioning system, will not issue a pre-approval on a rural housing loan. But you're right, and that's something that people have got to understand. And I know, you know, there's times when you overlook something or you miss something. Somebody says, well, I work for so-and-so and I get paid weekly or bi-weekly. And then when you get to kind of get the pay stub, you figure out that they work for themselves. So they're considered self-employed, right?
They somehow didn't realize that, huh?
Yeah, because, I mean, people don't realize, you know, I get a paycheck, yes, I've got a salary. But, and that's where it comes into, you really, as a lender, you have got to take the time to get to know your client. Talk to them, not, you know, don't just, you know, take that application. There's other things. When listening is a lot when it comes to doing a mortgage. Listening to the client means, and I'm saying your field, and as a realtor, it's the same thing. You don't want to be showing somebody a 10-bedroom house if they only need 5, right?
Yeah, exactly. So, I cannot imagine cleaning that. So
I don't either. I don't want to go there. But, you know, I would say, you know, somebody, I have that all the time, both from clients or realtors say, well, I need a pre-qualification. And I always try my best to make sure that I get clarification. Are you needing to know what your credit means?
Yeah.
I mean, because that's the first thing that really is the key in this whole deal is credit. And so many folks, you know, I love the fact that people are getting into having the credit monitoring, you know, the Credit Karmas or Equifax or whatever they use. and that is a great product.
Mhm.
But I've seen credit scores be as much as 100 points different
Yeah,
on their
I
Credit
have
Karma
too.
app.
Right.
And
they're like,
you have too.
yeah.
And that they're so disappointed, and nobody
Mhm.
wants to disappoint someone. But I think there's a
Yeah.
great reason to have those, because that does help you as somebody that, if you've got your credit is kind of, you're not sure of what's going on with it. I mean, that's a great way to watch it and to get to learn about it. If I paid my
Right.
credit card off this month, it
Uh-huh.
impacted my credit score last month or this month, the coming
Mhm.
month. It helps somebody, I think. Very
Yeah,
much.
but that is the thing is, like even when they go to buy a car, they say, well, my credit score is such and such, and they don't realize that that's not necessarily qualifying them for a loan either for a
Right,
house. It's a much
right.
bigger purchase, and there's lots of different things. But so that's just part of that you learn as you experience
Mm-hmm.
buying a home,
Right.
the different things like that. But there's still, so now you've got me pre-approved, and I
Yeah.
found the house of my dreams, and I'm
Yeah.
I've gone and written a contract and it's been accepted. So my next step is to start the actual loan process where you get all the documents that's
Yeah.
required. And
Yeah.
and I know from my experience with the buyers, if they don't get the things that you've asked them for in time, it delays a lot of things. And one, for instance, you have, like a 3-day thing on our contracts that you lock
Right.
in your loan. Well, you can't lock in a loan if you don't have, all your documentation and things in. And so there's lots of things that happen even after that with, so doesn't mean that you're actually absolutely going to be able to get this loan, because after all the documents are collected and those kind of things. Do you
Right.
ever do that up front before you, like for a buyer, if they are going to shop for a house, are you able to actually give them a letter that says that that this loan will happen because you've already collected
Yes.
all the information?
Well, and that if they have provided all their documentation, then you're going to get what's called a commitment letter.
A commitment letter. Okay, so that's what the difference is. So there's
That,
pre-qual and there's pre-approval, and then there's the commitments. Okay,
commitment. Yeah.
so that's what we want. That's what every
Yeah.
real estate agent's dream is to have a buyer that has a commitment letter.
Yeah, and most lenders don't do the commitment letter until they actually have the contract, or have,
Mhm.
because you can't lock a loan in until you have a contract or have a property identified. For us, you can. Other lenders may be able to, but I can't. So I guess that the thing of it is the recent changes, or the changes over the years that have taken place, is I can't require a client to provide me documentation
Mhm.
until they have done, they've reviewed a loan estimate, and this is after after they've identified the property, or even before the loan estimate, and they have done what's called the intent to proceed, acknowledged the intent to proceed. So I can't require them to. But what I always say to somebody is, we want to make sure, if you don't want there to be delays, surprises, then let's do everything we can up front to make sure we don't have surprises.
Mhm.
So, and that's the one thing that I have to say, our online mortgage application allows them to upload all their documents as they're doing the application.
Yeah, that's so convenient.
Yes, it is so very, very cool. I've got the stuff when I start in there, and I can look at it and see if there's any red flags. It's not demanding them or requiring them. It's suggesting. And that's the difference, is you cannot require it until they have actually done what's called the intent to proceed. You can offer that as a convenience, and our online mortgage application does that. I just closed a loan last month, and these kids just absolutely raved about how easy it was. And I was thinking, oh my goodness, I wish I could tape this, because they did everything online, everything. And but they've been working from home, so all their their business requires computer work from home. So it was just, they did online banking, and, so it was just easy for them. Not everybody does that, and I fully understand. And that's, we have to make allowances for those things, and provide a way for them to do that alternately if they don't want to do the online stuff. The online makes it quicker for everybody, and I always let people know that if you want to do this quickly, then here's what I would suggest you do, blah blah. And if you do those things, then it's quick.
One of the things I like about it is, once you upload it, it's there, and you don't have to worry about, okay, did they receive the fax, or did they lose?
Right.
A lot of times I've heard in the past, well, we don't have that. And underwriting has it, but they can't locate it for whatever reason.
Right.
And so this way, that they did receive it, and it's there online, and you can always go back to it. But I do like that convenience of it. And I think that most younger buyers are okay with doing that. Maybe some older people they're not very, electronically savvy, so they don't really appreciate it so much. And they'd rather come in and bring it to you physically.
There's a lot of folks that are still old school like me. I like to know who I'm talking to.
Yeah.
And for some people, that's, you're dealing with one of the largest purchases in their life.
Yeah.
And you're getting into their business as far as assets and their credit. I mean, this is very intimate, in my opinion it is.
It's like,
and so,
you want all of their DNA and their kids.
Yes. Yes.
I've heard a lot of people say, well, they even want my kitchen sink.
Yeah. A pint of blood in my firstborn is what we kind of jokingly say about it. But that's, for a lot of folks, they are uncomfortable doing this with, that one-eyed monster that they're looking at. And they want to know who they're handing their personal information over to. And that, I get that. In fact, that's part of COVID that I hate, was because I don't get to meet with clients like, or I haven't been meeting with clients like I am used to, because I enjoy that. But not everybody needs that. Some people do, some people don't. So that's the one thing that I have to say is, the step of getting the documentation. It's really, and what I generally tell a client is, I'm going to move as fast as you let me move.
Right.
If it takes you a long time to get me documents, then I can't produce your pay stub. I can't produce your W-2. So you're going to have to help me help you. You want to move this fast, then you're going to have to get it to me fast. And most of the time people will deliver what's expected of them, but it's just once they provide those things to you, then they've done everything that needs to be done. But a lot of times what happens is, they fail to mention that they have a Toyota, or this is something I know, Toyota's team members can lease a vehicle. Well, a lease does not show up on your credit report. Their lease does not show up on their credit report, but it shows up on their pay stub.
Right.
So that impacts their debt to, their ability, what they can buy. And so when I'm doing a loan with a Toyota, I have that in my mind. That's the first thing I ask, or one of the first things I ask is, do you have a lease? Is it on your credit report? And so that's the one thing is, if you get the credit report, which you would have, but then you get the pay stub and you see the $600 a month lease payment on there, that may have just blown your deal.
Exactly. Yeah. And that's interesting, because not all loan officers have the experience that you do, that they would even think about asking for that.
Right.
And that's the same thing with, with any profession. If you don't have experience, sometimes there's things that crop up that you didn't anticipate and couldn't have, but that's great. Gosh, there's just so many things that we can cover.
I know.
We're going to run out of time. And so hopefully next week we can cover something else. But is there anything especially that you want first-time home buyers to know about your programs, your loans?
Yeah, and I think you've got, well, this is, I did this for you to kind of give you an idea of what we can do as far as a listing that you have. We can kind of give you some different scenarios.
Right.
this one doesn't show the FHA, but I sent you over a kind of a comparison that shows you that, the difference. If you've got 3.5% to do an FHA loan, don't let that be the first loan you take. There's other options for you. And we have a 3% down conventional loan that is.
This is what you were talking about, right?
Yes, it is. It's the comparison. It gives you, it shows you your first mortgage. Don't let that name fool you, because it's not just a first home buyer loan. And it's got your first mortgage with the borrower paid PMI. That's that. And then the next one, number 2, is your first mortgage, 30-year LPMI. That's lender paid mortgage insurance. And then it goes to the FHA 30-year fixed. This is what drives me insane, is a client thinking they can only do an FHA because they only have 3.5% down. That's not the only option that's out there, but that's what they've been programmed to hear. This program here is phenomenal. If you look at the difference in the interest rate, look at the difference in the mortgage insurance. The rate itself is crazy, but when you put your 3% down, you end up with a 3% down payment. You end up with a 3% equity instead of, in this case, FHA, you got to finance that mortgage insurance, the annual mortgage insurance premium up front, and that increases back up. It eats up part of your down payment that you put down. But the long haul on this, it's what if the client, this FHA may be the only loan that you can get, but don't settle on that one until you've explored other options, because there are good programs out there.
Well, I'm looking at this just in the mortgage insurance alone. Is that 200? Is that per month?
That's per month.
My goodness. I got to put my glasses on for that one.
Well, but look at the one that, the mortgage insurance, the borrower paid mortgage insurance is $272.09. Right. But that goes away in 9 years. You slide down to number 3, FHA, and it's $227.34. It's on there for the lifetime. It goes down, but it's on there for the life of that loan. Okay.
So now, So in looking at this, it's a 30-year fixed, and the borrower paid mortgage insurance that adds $272. Now this is this is the $335,000 home.
Yes.
And the down payment is where is that?
3%.
It's 3%.
Yeah, it's 3%.
Okay, but if you I
did 3.5.
The lender pays it, which you're saying that there wouldn't be a 200. That's quite a bit of savings, even though you're paying a higher interest rate. Right. In the long run, it looks like that would be better, and then you don't have to worry about the mortgage insurance going away in 9 years at all.
Yeah.
But comparing that to an FHA loan, it's still a low down payment. But the insurance that you pay is for the life of the loan that never goes away until you refinance it.
Exactly. And I guess that's the biggest, to me, is the biggest thing is look at the options that are available to you. Don't just take what a loan officer is used to doing. If you get into the habit of doing an FHA loan and not exploring any other options, then that's what you're going to fit everybody into. But everybody don't fit in that. They don't have to. So, but they don't know what they don't know. If you don't tell them there's something else out there. I sent you over 2 amortization schedules that shows you. Did you look at the difference, the bottom line, FHA versus the conventional?
Well, here's the conventional.
Yeah, it's crazy.
So, and then the FHA here. Yeah.
Yeah, it's like 111,000. Oh, yeah, it's $111,000, $112,000 difference in the bottom dollar that you will end up, the interest that you would pay, and the total payment is, just insane. It's $114,200.
Wow.
It just is. That's probably the biggest thing that I would tell any buyer is make sure. Yeah, it is. just make sure that you explore all of your options.
Mm-hmm.
You know, get a hold of a loan officer. If you don't feel like that they're answering your questions, then you find you somebody that will answer your questions. There is this is your money. This is one of the biggest purchases you'll make in your lifetime. You get a hold of somebody that you can trust with your money, because basically it's your money, and ask those questions. You've earned that right. Ask those questions.
The loans that you provide, you're not a broker.
No.
And a lot of things, there's so many different types of lenders out there. Like, you know, you've got your mortgage brokers, and then you've got, which Wells Fargo is a bank, but, you know, you have your banks, and they can still, you know, sell the loans to other investors. And that kind of confuses the whole scenario too. And because you're dealing with people that are loaning money, and then they're selling your loan and their benefit. So there's just lots of things. And sometimes they can't, you know, get the loan processed as quickly because of the way that they underwrite. And so, you know, again, it just all goes back to experience, and, you know, knowing that that you're aware of what your options are, so you can make good decisions and not just take whatever somebody, just because they qualify you and you can get a loan. So, you know, and I it seems like recently that, you know, when COVID hit, it kind of got a little confusing because things started, you know, shifting so quickly, and then we went back down, and then, you know, so but right now it seems like it's stabilized, and the interest rates are still very affordable, very low. And you know, the thought that COVID has just completely eliminated your possibilities of buying a home is definitely not the problem. The problem is finding a home, because there's so little inventory. You're competing with a lot of other buyers. So that's why it makes it even more important that you get a strong qualification. You know, the commitment letter would be awesome, but at least a very strong pre-approval. And
and I think that's the key is, you know, you want somebody that's got experience. You want somebody that knows their product. They're not going to have to be brokering it out to I don't know who all the brokers are now, but that do, you know, wholesalers or whatever they are, because their underwriting guidelines can change quickly. I mean,
that's what I mean. It's just it's crazy. And you know, just because, you know, I was told one thing one day, and I'm like, this is probably you know, a good situation for the buyer, does not mean that tomorrow. And again, you know, we can be under contract for a house today, and then 2 weeks later find out that you know, things didn't, you know, shape up the way that it was supposed to. And so I'm probably going to run out of time here real quick. So let's just go over this this scenario you gave me. Like, if I was having this open house today, these are 3 different options that people could look at. So
I put together 3 of them. And the first one was a VA loan. That's 100% financing, of course. And that is one of my favorite loans to do. I can't, I mean, that's that's something that is very close to my heart, is doing a VA loan.
Right.
They're a great loan, and lots of folks say, oh, they're horrible. They're not. You've got to know what you're doing, but they're not bad loans. And then, of course, that's no down payment, you know, assuming that the veteran is not receiving service-connected disability. So you're financing some money on top of the $335,000 purchase price. The second one is a 3% down conventional, your first mortgage. Now, that one is very interesting. That product, if somebody qualifies for that, they're going to do a home buyer's education program online that takes, I've had people say 4 hours. I've had people say it took me 4 days. Not computer savvy, right? And you get a $750 credit toward your closing costs for that loan. And any loan with us that's you put between 3 and less than 5% down, you can do the home buyer's education and get a $750 credit towards your closing costs, which I think is awesome.
Yeah.
And then I threw in there a 5% down because that's kind of, a lot of banks offer a 5% down. And you can tell the biggest difference being there's about a 0.25% difference in the interest rate. You know, so that would be something if somebody had the extra funds. It changes your payment by about $74.
Yeah, that's not much.
Yeah, not a whole lot. And, you know, in today's day and age with everybody, I mean, hey, Penny, we're short on coins. So,
Right.
I mean,
Oh gosh, that's a whole nother conversation.
I know it is, isn't it?
So I mean, that's really interesting. That on the first time mortgage, you got less down payment, a little bit higher interest rate. But if you pay 5% down, the interest rate's lower, but your payments are almost the same. That's interesting.
Yeah, there's not a whole lot of difference, is there?
No. And the mortgage insurance probably has a little bit to do with that. But again, we want to emphasize on the mortgage insurance that it's only, what, 9 years?
Not about 9 years.
A lifetime.
Yeah. And that's the one thing is that the scenarios that I showed you on the other loan, you know, the conventional versus, that was based on a 640 credit score. The ones that I did here are based on about a 700 credit score. So your mortgage insurance is going to change depending on your credit score. So, you know, I mean, that's just part of it. But it impacts, credit score impacts so much anymore that it's, you know, it's important for folks to know what your score is. So, but I love that, the fact that I can do something and get $750 toward my closing costs. I mean, that's tremendous, you know? So, yeah, I mean,
that's a lot. That's a lot.
Okay. It is a lot.
I'm just afraid that I'm gonna get cut off here really quick. So we'll wrap this up. But you know, next week when we talk, let's discuss some other things, not necessarily just the home buyer program, but there's just so many topics that we can cover, and we have, you know, don't have enough time to go over that, and then people might, you know, quit watching us if it goes too long.
We might have to do like a song and dance or something to keep them entertained.
Add some music to it.
Some music, yeah.
Well, Tina, I sure do appreciate it. It's very interesting and informative, and look forward to talking to you next week.
All right. Thank you for asking me. I really appreciate it. I've had a blast as always. Buying a house should be fun. It shouldn't be stressful, you know?
That is true, but it can be, especially when you don't have somebody that's that is familiar with the process.
You're exactly
right. Have a great afternoon, evening.
You too, lady. You too.
See you later.
Thank you so much, Shari. All right. See ya.
Bye.
Bye-bye.